Hello, everyone, and welcome back for another Indie Wealth Monthly Market Update. As always, I'm your host, Nathan Zimmerman, and today I'll be covering a volatile month of July, provide an update on second quarter earnings results, and provide some thoughts on what may happen next. But before we get started, if you like these videos, please take a moment after this video to follow our Facebook page if you haven't already. I post these videos as well as a lot of other useful content there periodically. Now, having said that, let's dig into July. Now, as I mentioned, July was a volatile one for the major indexes. At one point in the middle of the month, the S&P 500 was down by about 3.5%, and the more tech-heavy NASDAQ was down by 7%. As I've been saying for months now, we should expect volatility ahead. And we've had relatively tame markets in 2026, and that is simply not the norm. I'm a believer that water tends to find its level, so when things have been relatively calm for a long period of time, I start to expect some volatility. And in July, we finally got to see some of that. However, by the end of the month, the S&P 500 had rallied back to finish the month level and up about 10% for the year. Now, the NASDAQ was also able to rally from the mid-month lows to finish the month down by only 3.4%. But again, that index is still up more than 8% for the year. Now, just in the first few days of August, we've seen positive market results, which, as you can see in the blue bar above, has now pushed the S&P 500 year-to-date return to nearly 13%, up from 10% at the end of July. The biggest winners have been energy, which is unsurprising given the jump in energy prices this year due to the war in Iran, and technology and industrials. But you can see that all 11 sectors of the S&P 500 are in positive territory for the year. So this market is getting contributions from everywhere. It's not as narrow as you may be hearing. And 6 of the 11 sectors in the market are up more than 9% year to date. So this is a broad-based market advance, despite what you may be hearing when you turn on your TV. So what is supporting this move higher in 2026? Well, I'm sure you know what I'm going to say here. We need to look no further than earnings. This chart shows us the earnings growth for the companies that make up the S&P 500 index going all the way back to the year 2000. Now, it's easy to see that earnings growth is accelerating here recently, and the stock market is following suit. Over the long term, stock prices will tend to follow earnings, and earnings continue to surprise to the upside, as we can see in this chart. So let's take a moment to focus in on recent earnings. Over the past few weeks, we've been hearing from companies about their financial results in the second quarter of 2026, and the results have been quite impressive. So far, about 400 of the S&P 500 have reported earnings, and 88% of those companies that have reported earnings results have been much better than analysts predicted. And when I say much better, the average company has reported earnings 30% above analysts' expectations. So overall, analysts had been predicting earnings for the companies in the S&P 500 to grow by about 23% in the second quarter of 2026 versus the second quarter of 2025. That number, however, is tracking closer to 48%. Now, the biggest contributions have been Amazon and Google, which reported massive earnings results. But even if we remove them from the picture as outliers, earnings growth would still be 29% for the rest of the market, well above estimates. Now, this will be the second straight quarter of 20% or greater earnings growth and the 7th consecutive quarter of double-digit earnings growth. That's not too shabby. And again, the earnings growth isn't just happening in technology. 8 of the 11 sectors of the overall market are reporting double-digit earnings growth year over year. Now, if you follow my updates, you know that I spend a lot of time focused on earnings rather than headlines or politics or whatever else is moving the market day to day. So why am I so focused on earnings? Well, this chart really says it all. Simply stated, the stock market over the long term follows the path of earnings. This chart shows us the S&P 500 in dark blue next to the earning growth chart that we saw earlier in light blue. They may not be in perfect unison all the time, but the correlation is pretty clear. Rising earnings usually translate to rising markets, and that's what we've been seeing over the past 2 years, and that's the way that it's supposed to work. Now, having said that, there are still risks to the market, but there always are. Corrections are normal, even in good times. 2025, for example, was a great year for the stock market, rising more than 15% for the year, but we still had to endure 6 separate 5% or greater corrections along the way, including a larger 20% drop that we now refer to as the tariff tantrum. Corrections are a feature of the markets, not necessarily a symptom that something is wrong. Now, we'll want to keep an eye on the Federal Reserve and what they do with interest rates. If they were to embark on another rate hiking campaign, that could certainly bring some volatility into play. If things in Iran were to escalate again, that could bring volatility. We've got midterm elections coming up later this year, and that could certainly be a source of volatility. But just remember, corrections and volatility are normal and not a reason to change your investment plans. Over the past 40 years, we've seen over 200 5% or greater corrections. 30 of those were 10% or greater, and 10 of those were 20% or greater. And despite all of that, $10,000 invested in the S&P 500 index in 1985 would be worth $1 million today, reflecting an average annual growth rate of nearly 12%. And all you had to do was get invested, stay invested, and not react to the numerous moments along the way where it may have felt like you should change your plans. That's going to be it for me today. Thank you for tuning in again, and you'll hear again from me soon with more market updates.